Okay, so this tutorial deals with the mystery that is negative gearing as it applies to a rental property. And to start the explanation, first thing to do is to hop onto our website, which is newtowntax.com.au, head into useful information, tax checklists, worksheets and templates, and open up the rental property summary schedule. The rental property summary schedule shows the information that needs to be recorded when you're preparing a rental property schedule. That's dealt with in an earlier tutorial. And essentially, for tax purposes, the net income from the rental property is the rent received and any other income like water bills if the tenant pays you a reimbursement for those, less all of these things here. So what I've done is to take this worksheet here and prepare the same information into Excel here with the same headings so that we can have a calculation that shows the net income for the rental property for tax purposes, and we'll then be able to explore what positive and negative gearing are and what they mean in your tax return. So we're going to invent some realistic figures here. Rental income for a 2 or 3 bedroom house in the local area, probably about $34,000. Let's assume the property was tenanted throughout the year. Body corporate fees, freestanding property, so no body corporate fees. Borrowing costs are something that we work out for you. No cleaning needed to be done. Council rates about $2,000, $400 for the gardening, $2,000 for the landlord insurance. So imagine it's at the beginning of the term of the home loan, so about $28,000 for the home loan. No land tax, legal fees, pest control, $2,400 for the agent's commission, no repairs, stationery, travel expenses, $600 for the water, and no sundry expenses. What that tells us is that the net income for tax purposes is minus $1,400, and if the property was newly constructed or renovated, then you may be able to include deductions for these two things, capital works and capital improvements. This can actually make a tremendous difference to how profitable the property is over time, and certainly it can make a big difference and a big improvement to your tax return if you have a comparatively new or newly renovated property, because these are the only tax deductions that you can claim where you're not incurring out-of-pocket expenses in order to be able to claim them. And these deductions arise because the construction costs of the property and all the fit out of the property depreciate slowly over a period of time, and surveyors like BMT and DEPRO can produce a schedule for you to tell you what to include in your tax return every year. So we're going to put some numbers in here for capital works, which is to do with the building costs, and capital improvements, which is to do with the fit out. See that that's made quite a big difference to the net income for tax purposes. Now you'll notice that this figure here is negative, which means that the effect of the rental property acts like a tax deduction within your return. So to calculate what the benefit is from that, you need to take a look at your own income, and we're going to use a website called taxcalc.com.au, which is here. And let's just imagine for a moment that your salary is $90,000. Your employer covers your tax for that entirely. So on a $90,000 income, you pay a total of $23,047 tax. So we have 23,000. I think I just forgot the last few figures. Let's get them again. And $47, 23,047. Now, after the negative gearing is accounted for, what that does is to actually reduce that $90,000 by $6,400. So your income is going to be less that. Actually, that's right. And we now look at the tax that's payable on the new income of $83,600. So let's go back to taxcalc.com.au, $83,600. Calculate that. The new tax payable is $20,551. So the effect of negative gearing in your tax return here is to improve your tax outcome by $2,496. Now there are a few general things to be aware of with negative gearing. First of which is that home loan interest, if you have a loan which is anything but interest only, is going to diminish over time, because as time goes by, more of your money is going towards reducing the principal of the loan, in other words the debt, and because the debt's reduced, less of the money that you're paying goes toward the home loan interest. So over time this figure has a tendency to decline. This figure, rental income, has a tendency to increase in most parts of the world. So overall the net income from for tax purposes tends to improve over time, which means that the tax benefit from negative gearing fades away. This is another reason why these capital works and improvements can be very helpful over the long term, because they tend to be fairly static over a long period of time for newly constructed properties, and they are the only things which, as I say, will improve the outcome of your tax return, where you're not actually physically having to spend money out every year. So that's negative gearing. Positive gearing happens when the income from the property for tax purposes, which is not the same as your out-of-pocket costs, the income from tax purposes is actually less than the rental income. What then happens is that instead of being negatively geared, you become positively geared, which means that your income is improved. And in this instance, we look at what the tax would be if you had an income of $97,600. So going back to tax calc, 97,600, calculate that, and that gives you a total tax of 26,011. Which means that your tax return is actually worsened by $2,964 based on the positive gearing. So over time, most properties have a tendency to start off negatively geared and become positively geared as the loan becomes repaid and as the rental income starts to outstrip the other costs associated with the property. It's quite useful to stay in regular contact with a financial advisor, because there are various options that may be open in terms of how to manage multiple rental properties, or how to set up arrangements if you have a place that you're living in and an investment property too. And there can be ways of, for example, looking at the interaction with superannuation, self-managed super funds, and also the possibility of exploring further purchases and using the equity that you have as leverage. But as far as your tax return is concerned, what gearing acts to do if the property is negatively geared is that you have some tax relief on the loss for tax purposes of the property, and the higher your income is, then the greater the benefit is likely to be. If your income was under $18,200, for example, then any benefit from gearing is lost, because if you're below the tax-free threshold, you don't pay tax, so there's no scope to improve your return. So negative gearing tends to work better for people who have an income of at least $37,000 before the gearing, and it comes into its own in the higher income brackets. So that's just a brief summary of what negative gearing is and how it interacts with your tax return.